I'm going to talk about a couple other things here. I had a dealer just the other day call me up. I stopped in his office, and turned out we hit it off pretty well. And he said, "Yeah, I've already done cost segregation, saving about $120,000, but it's pretty expensive." I said, "Expensive? How much did it cost you?" He said, "It was about $9,000." I said, "So let's see, 9,000 and 114." He said, "Well, I guess it really wasn't that expensive." Anyway, he was a friend of mine who referred me to him. Well, he calls me up. He says, "Tony, I do this thing. I have about 20 or 25 dealers that every quarter we meet and we have to give a little presentation. Can I give one on cost segregation?" I said, "Well, sure you can." I put a nice package together, sent him 22 packages, what he needed, and did a little quick PowerPoint. He did 8 minutes of my PowerPoint, and then he sold these guys, and he said, "I guarantee you're going to get business out of it." Well, this is one of the pieces I put in there. Cost segregation increases cash flow for car dealers. Do you know any car dealers that might need cash flow right now? Sort of a leading question. You are still there?
Yeah,
David?
we're here. Okay. We're here. No, we're here.
I just wanted to make sure, because 2 and 3 years ago, understand that you had guys that are selling SUVs and Hummers and blowing and going, making tons and tons of money. Well, where are they now? They're closing down dealerships. Guys are struggling to keep, cars on the lot to pay for them. Well, cost segregation is a great deal. If you guys don't know, I'm in New Orleans, and obviously you've heard about Katrina, and it really affected a lot of car dealers. There was one car dealer here in town, had like 5 dealerships. Well, a couple of the dealerships got blown away, and the other ones were ruined. They weren't selling any cars. People weren't here. They were literally dying on the vine. Well, he had 5 good general managers. He didn't want to lose them, but these guys were starting to get offers. Guess what he did? He cost-segged one of the buildings that didn't have a problem. He got himself like $125,000. He got to sustain his general managers and keep the guys he's been working with, as opposed to losing them to competition. But we have different articles just like this that are very supportive for what you want to do. We have other CPA articles, not just that one. Let me get rid of that one. Well, here's just another study I'm doing right now, as a matter of fact. Can't get rid of this thing here. But just to give you an idea, this is one on a larger deal. For this guy, we're going to save them in the first year $699,000, $724,000 through 212, and the net present value on this is $503,000. As you see, if he does all the properties, we're going to give it to him for $55,000, and after tax, that's only $35,000. You get $700,000 back. So this is if you have a specific multi-property location. You can go ahead and we'll put a little package together like this, which shows the timeline, etc. But it's a dynamic program. You got excellent support. So let's shoot to some more questions, and see what happens after that.
And let me just kind of, real quick, just kind of summarize everything. Basically what happens is you gather that initial information that we talked about. You want to cover that real quick once again, Tony, what the pre-qual, if you will, information that's required to be gathered.
Right. Well, number one, let's make sure we got the criteria. It's got to be after 1986. You have to have some kind of tax liability, so it's no nonprofits. And you don't want to be selling within the next year or two, okay? If you do those things and it's a $300,000 building and above, or multiples, you can go down a little lower, or renovations down to $100,000, that's the first criteria. Then, in order to get the information, obviously we'd love to have the depreciation schedule because it highlights what they've already done, if they've done any of it. Otherwise, we just need the type of property, when it was acquired, what the cost was minus the land. If you got any other pertinent information, the type of building, whether it's retail or a storage company or a medical building, an office building, a hotel, and that sort of answers some of the questions you were asking before on the types of buildings that we've done, car dealerships, you name it. But virtually any standing building is okay. As a matter of fact, there's, when you go back to like 1987, normally it's not a good deal because understand, 87, now it's 2009, 22 years of the 39 have been taken. All right, so you're not going to get the same big bang for your buck. So if it's a couple $100,000 or $1 million building, it might not be worth it. But we had one guy said, well, it's not worth doing it because it's, 20-something years old. Well, we said, well, let us take a look at it. It was a $50 million factory. The guy saved $1 million. So he was happy with that. But that's basically all the information that's needed. It's real simple, 5 or 6 pieces of information. And once you go through the training, you'll see all you do is pull up the website and say, you want to submit a request. You plug in those 5 pieces of information, and in 2.5 days, you're going to have that information back. And a lot of times I'll walk in, I'll say, have you had cost segregation applied to your building? He said, what? Oh, I guess you haven't. And basically, I'll say, well, we save anywhere from $70,000 to $100,000 for every $1 million in building value. And I'd like to, you said this is about a $2 million building. We're probably talking $150,000, $160,000. Would you like to see what we can do for you? Well, yeah, well, what's it going to cost? I really don't know what it's going to cost. It depends on the type of building, the size of the building. It's basically time and effort. But I'll tell you what, I'll not only tell you what the cost is, I'll tell you what the projected savings are. If you like it, great. If you don't, no big deal. Now, obviously, what that does for me is it gives me the opportunity to get the numbers in his face. Then you can crank him when you're sitting down because you got to be crazy not to do it. Understand what I'll say a lot of times. Do you have any kids? He said, yeah, I got 3 kids. Do you take the dependent deduction? Yeah. Well, that's the exact same thing you're doing here. This is an allowable deduction that you're not taking. Would you consider not taking your dependent deductions for your kids? Well, no. Well, then you shouldn't do it here either. So it's either your money or the IRS. Where do you want it to be? Well, I want my money, and that's all that's to it. So very simple to get the process rolling. Now, any other questions?
Absolutely. And I think you've already answered this, but I'm just going to get it out there to make sure that this person gets their question answered. What is the minimum value of property should be worth in order to make it worthwhile doing?
Well, I said it's about $300,000.
Okay.
Would be the bottom line, unless you're dealing with multiples, and I'll go down to $200,000. And if I'm dealing like I did, the first one probably was 30-something properties. There were a couple in there that were small, but most of them were large. But now this is something, if you can still see the screen here, these are different examples of things that you'll be able to utilize. And I want to quickly run through what the feasibility study looks like. So when you get that information, those 5 or 6 pieces of information, you're going to get a study that looks like this. And as you see, this is a bank. When it comes back, the building was $1,450,000. And that's what I'll do. I'll verify. Mr. Jones, it was $1,450,000, correct? Right. And you got that in January of 2002, correct? Okay, this was for tax year 2006. Well, currently, if you had straight line depreciation, you're going to have about $184,000 in depreciation expense. After our engineers take a look at your building, we're going to wind up with $362,500 in 5-year property. We found another almost $60,000 in 15-year property, and your 39-year structure should be $119,000, $120,000. So your new depreciation that we're going to hand over to your CPA for that filling out that form for the change in accounting is $541,000. So understand, you got $184,000 now. We're bringing $541,000 to the bottom line. That's a difference of $357,000. At your tax rate, Mr. Jones, that's going to put $128,000 in your pocket. Would you like the $128,000?
Wow.
So this is what we're talking about here. Now, along with this, there will be an engagement letter. And if he likes it, he says, yeah, that sounds great. What's it going to cost? Well, let's take a look. Here's your engagement letter. You go ahead and lay it out for him. And he either signs it or not, just half up front, half not. But, I mean, half when it's done. So it's, sometimes you get a guy to be a little recalcitrant. They think it's too good to be true. But all you got to do is talk to their CPA or get your CPA on the line if he's got any questions. But, in anything that we do, you've got to gain the trust. You got to go in there and know a little bit about what you're talking about. And if you do that presentation a couple times and go through the training, you're going to be ready. You're going to know more than 95% of the CPAs that are out there.